immune from that.
Okay, let's talk macro. The U.S. economy seems to have been doing much better than many expected. We had a 4.3% read in GDP last quarter. How would you assess the United States economy?
I think that it is very strong and likely accelerating. And Maria, just to be clear, that 4.3% GDP was private sector GDP. So, or actually, after the fiscal contraction. So the real number was 4.7. The government contracted by 0.4, so that got us to 0.3. So that is pure private sector GDP. And President Trump's economic policy, tax deals, trade deals, and deregulation. The deregulation, which I think is probably the most powerful part, is really just starting to kick in now. So we have the tax deal, one big beautiful bill, done on July 4th, which no one said could be done. And it contains the full expensing for U.S. corporates on equipment, for factories, for ag structures. On the other side, for working Americans, the president's signature policies: no tax on tips, no tax on overtime, no tax on Social Security, interest deductibility, auto loans if you buy an American car. So we're seeing this wonderful balance between industrial America and Main Street America. I am also the IRS commissioner, and we did not change the withholding guidance. So we're going to see, as commissioner, I can see there are going to be very substantial tax refunds coming to working Americans in the first quarter. They'll change their withholding. They'll get a bump up in real incomes. Because of the expensing, we're seeing 12, 14% Capex growth in the U.S., and historically, you have never seen a Capex boom without seeing employment follow.
Yeah, you've got a Capex boom and a productivity boom as well. 4.7% is much better than so many people expected last year. Are you expecting the economy to, at one point, hit 5% as well?
Well, the Atlanta Fed GDP number, which is a very noisy number, is now reading 5.3 because remember, the fourth quarter GDP included the Schumer shutdown. So some of that will be pushed into the first quarter. So I'm expecting that we could be well north of 3, and we'll have inflation coming down. As you said, productivity is very high, and we have measured inflation and observed inflation. And with the observed inflation, I think we can see that prices are already down, and that will trickle into the CPI and the PCE, which the Fed looks at.
Well, it's a good point, because there is still a perception that prices are still high.
Well, prices are high. The Biden administration was a wipeout for working Americans. That the price level increased by 21, 22, 23%. But our friend Jason Trennard, the strategist, has something called the Common Man Index, and that is, what do working Americans buy? So basket of groceries, insurance, rent, car payments, and that was up in the mid-30s. So very difficult, other than with energy. The president, through Drill Baby Drill, has gotten gasoline prices down. We're below $2 in many states. National average is below 3, even if you throw in the outlier of California. And so that we can get down. And we are working every day to get things down. And affordability is two pieces. Affordability is price level, but it's real incomes. Real incomes have gone up every month since President Trump took office. And as I said, I think we're going to see a big year for real incomes this year.
Wow. And you said, in terms of the tax refunds, are we talking about thousands of dollars that people will be getting as a result?
We could see, for working families, for each wage earner, we could see up to $1,000 per wage earner.
Okay. You said that prices are still coming down, but they're still elevated. The president announced many things, a litany of things, just in the last 100 days. And I want you to walk through some of these things and tell us why they're important, because he put a ban on large institutional investors purchasing single-family homes. He asked for $200 billion purchases of mortgage-backed securities, and he put on a proposal for a 10% cap on credit card interest rates. We know credit card interest rates are always soaring, up to 28, 30% in some cases. That's going to cut into earnings of the bank, certainly. And he also teased something about 401ks, that you would be able to tap into your 401k to then buy a home. Walk us through these things. Why are these so key, in your view, to growth and to reining in prices?
Well, here, why don't we start from the beginning? So,
the first thing was the ban on large institutional investors purchasing single-family homes and the purchase of mortgage-backed securities.
yep. So the ban on institutional investors in single-family homes, for those of you who are not American, in the U.S., pre-Great Financial Crisis, institutional investors did not participate in the single-family market. So post the financial crisis, institutional investors hoovered up single-family homes. They continue to do it, and there's an unfair tax arbitrage there. You and I have a mortgage. We can deduct the mortgage amount. Institutional investors can deduct the borrowing amount, but they can also expense any repairs and depreciation. So we think that it is a good idea to have them out of the market. We are going to give guidance at some point to see what is a mom and pop, that someone, maybe your parents for their retirement, have bought 5, 10, 12 homes. So we don't want to push the mom and pops out. We just want to push everyone else out. And what's important here, you will hear some misinformation that says, well, institutional investors are 1, 2, 3%. That is true. Having been in markets for 35 or 40 years, markets are made on the margin, and institutional investors are much higher in boomtown markets like Charlotte, like Atlanta, like Huntsville, Alabama. So they've done that. In terms of having Fannie and Freddie buy MBS, the mortgages are two parts. It is the 10-year bond yield, and it is the spread between mortgages and the 10-year yield. So the purpose of that is to narrow the spread.
Okay. The cap on credit card rates is expected to cut into bank earnings between 5 and 18%. Your reaction?
We've done a lot this year. Bank stocks are at a new high. That through my position on FSOC, the Financial Stability Oversight Council, and the 3 bank regulators, the Federal Reserve, the OCC, the FDIC, we have done a lot to deregulate banks. Their earnings are way up. More importantly, it has increased their lending capacity. Oliver Wyman's numbers, not mine, estimates that there's $2.5 trillion of extra lending capacity. The other thing that has been a focus of this administration and a focus of mine is small and community banks, because what happened after the Great Financial Crisis, all the regulations from Dodd-Frank, we had too big to fail. But then with small banks, you were too small to succeed. This regulatory morass, we have lost more than 50% of the small and community banks. And they power small business lending, real estate lending, and ag lending. So we are trying to bring that back.
Yeah, it's a great point, because farmers really need the lending of these small community banks. Look, Secretary, I want to get your take overall on your thoughts on what you've done so far, because the president back